Thank you for joining us today. My name is Michael Chiruka from the law offices of Michael Chiruka, and we decided to offer this program today basically because of the extraordinary period we are in. We have been through probably the most contentious election, presidential election that history can recall. We have had, the other side of that is we have also had the most people ever vote in a presidential election for both parties. So we've had engagement. We're in the middle of a COVID-19 global pandemic, which I don't think there's anyone alive that I know anyway that has experienced this before, and it has caused repercussions for tax planning, for estate planning, for healthcare, for the economy. We're in the middle of another recession. We have a historic low interest rate period. All of these factors coming together at the end of 2020. And the idea here is to hopefully offer you a program that will give you an idea of where we actually are at and what you might be able to do before the end of the year and what you might have to look forward to or not look forward to in 2021. Joining us today are Tony Conte from Conte Wealth Management and Steve Lubart from SEK CPAs and Associates. And we're going to try to give you a broad perspective from an income tax, from a financial planning, and from an estate planning perspective of hopefully some ideas of what you can do and maybe bring some calmness to your world or some confidence that things will get better. We're going to start off the program with Steve, and he will take us through mostly the income tax situation these days. Steve?
Thanks, Mike. I'm Steve Lubart, CPA with SEK CPAs and Advisors, and I'm going to be touching on Joe Biden's tax plan for the upcoming 2021 and beyond. The main thing that got a lot of attention was raising the income tax rate on the highest income earners. And the highest income earners has been identified in his plan as over $400,000 of income. That could be individual or married. That is to be determined, but it is $400,000 that's been identified here. The highest income tax bracket is 37% currently, and that they're looking to raise that to, or has been proposed to raise that to 39.6%. An individual making $500,000 would pay an additional $4,600 in income tax under this proposal. And an individual making $1 million would pay $17,600 additional tax under the proposal, which includes raising the income tax rate to 39.6%. The second item that received a lot of attention was the Social Security tax, or what was referred to as the donut. Right now, under the Social Security tax, an individual pays Social Security tax up to $137,700. That Social Security tax is at 12.4%, and once they go over $137,000, currently there's no tax paid for Social Security. When an individual under Vice President Joe Biden's plan, the proposal is that once they go over $400,000, that number again, then the FICA tax or the Social Security tax would kick in again. And for an individual that makes $500,000, so they would have $100,000 over the $400,000, that individual would pay an additional $12,400 of Social Security tax. That tax is paid by both the employee and the employer. So the $12,400 would be split, if they were employed, would be $6,200 for the employee and $6,200 for the employer. So you can see this tax is a burden for both the employee and the employer. And to raise that to a higher number, if an individual made $1 million, that would be an additional $74,400 split between the employee and the employer. If the individual was self-employed, they would be paying the full amount of tax. So we see that commonly on Schedule C self-employed individuals. They would pay the full $74,400. So as you can see, that's getting a lot of attention, and that is a significant tax increase.
Steve, can I ask you a question about that? That space between 137.7 and 400, under the, Biden's proposal, the expectation is between those, those numbers, there will be no additional Social Security income tax today, right?
Correct. Under his proposal, there would be no additional Social Security tax between that 137.7 and the 400,000. That 137.7 usually rises. It's usually an inflationary thing, so it would be closing throughout the years. But
Well, that's interesting. So the intention is to allow that to close the gap.
the intention is to allow that to close.
Okay. Thank you.
Okay. Okay, the third item that has received a lot of attention is the corporate income tax increase, the C Corp tax rate. Currently, the C Corp tax rate under the Trump administration is 21%. That rate has been proposed to be increased to 28%. So a corporation that makes $1 million in profit, bottom line, net income, would be paying an additional tax of approximately $70,000. So we can see that's going to be a significant tax. So that could put a detriment on those companies being able to provide benefits to their employees, being able to, whether they're going to have to cut other expenses in order to be paying that additional tax at the 28% rate. Now, what's to be determined is, does it settle on 28%, or does that rate, we're hearing a lot right now, whether that rate would come down to maybe a 25% rate. But right now, the proposed rate is 28% for the C Corps. Additionally, there is a proposal on the table because for minimum book tax, for companies having net income greater than $100 million, there being a 15% tax on book tax. You may ask, what is book tax? What book tax is, it's almost like two sets of books. A company would have taxable income, and then they have book tax. What happens there is there's a lot of items that maybe are taken for tax purposes, but not taken for book purposes. And the common thing is accelerated depreciation or writing equipment off all in 1 year. So they're trying to close that gap for companies that maybe have no income or a net loss, but for tax purposes, but book income is significant. So they're trying to implement a 15% tax on book income. Additionally, under Biden's proposal there is a 10% tax for we're calling an offshore penalty surtax. So that tax would be of profits that are made in the United States, but the production is being done outside of the United States. So they're bringing that products in. The business is being done in the United States, but the production is happening outside of the United States. So that's the 10% offshore penalty surtax. Another item that a lot of small businesses and large businesses have had a benefit of is called the QBID, or the Qualified Business Income Deduction. That deduction is equal to 20% of pass-through income, and it's also available for Schedule Cs or sole proprietors. Right now, this $400,000 number comes back. Anybody who makes over $400,000, the QBID deduction would go away. So that would be a significant hurt to those businesses that are utilizing that. So more.
Steve, that also represents simplification of the tax code as well, doesn't it? Because I remember talking to business owners when this originally went into place, and it took me at least quite a bit of time to figure out who exactly could benefit from this thing, from the QBID.
Yeah.
With this shift, it's pretty abundantly clear who will benefit from it and who will not. Is that accurate?
Yeah, and it's going to, right now what had happened is the QBID deduction was available for a lot of different businesses, even if they were not professional services, because some of the professional services were not able to get the QBID once it started to get phased out at numbers like from 321 to 421, and 421 it might be completely phased out. Now this is just saying all businesses over $400,000 would not be able to take advantage of this.
Much easier to understand.
So it is a simplification, and that understanding that QBID when it came out was very complex tax law.
Especially for people like me, right? Who work in the tax world entirely, right?
Are they doing anything with the aggregate? A lot of times small businesses would create several entities to take multiple advantages of that. Are they going to aggregate those for the 400,000, or they haven't addressed that?
Yeah, I have not seen anything about that yet. Okay, the last item I want to touch on is President-elect Biden's tax credits that are out there, which we're seeing a lot of benefit for the tax credits that are there for individuals and businesses. The first credit is the Earned Income Tax Credit, which is being expanded for childless workers over age 65 years of age. Also, a number of energy credits are being reintroduced. The Child Tax Credit is being expanded to $3,000. It's currently at $2,000, and there also would be an additional $600 for children under age 6, and this credit would be fully refundable as well. Another item that received a lot of attention was the Child and Dependent Care Credit. So currently the credit is for $3,000 worth of expenses for one child and $6,000 worth of expenses for two children, and that credit is up from 20 to 35% of the expenses. They're looking to increase that for $8,000 worth of expenses for one child and $16,000 worth of expenses for two children, for a credit up to 35 to 50% of those expenses. This is one that just came out that's pretty interesting, that was introduced by Joe Biden, was the credit for first-time home buyers. We last saw that in 2010, and that was a home buyer credit for $8,000. That's being reintroduced for a home buyer credit of $15,000 for first-time home buyers. Also included is a work opportunity credit, which is being expanded for military spouses, and also a Made in America credit for a 10% credit for companies that create jobs for American workers. I'm going to turn it over to Tony, who's going to be talking extensively about retirement and capital gains.
So I'm Tony Conti with Conti Wealth Advisors, and I'll be talking about the impact of some of Joe Biden's proposals on the wealth management and financial planning space. Anytime there are talks of tax increases or changes to the tax code, in my mind, that represents an opportunity for us to plan, right? So one of the, I think, more interesting aspects of Joe Biden's proposals and plans is this idea that 401k plan benefits on the traditional 401k plan side should be equalized across the income spectrum. So the idea behind this is that traditionally, because you get ultimately what is kind of like a tax deduction for your savings into the traditional 401k plan, traditionally it's seen as a progressive tax benefit, which means that the higher your income, the higher your tax rate, the greater the benefit to you. So if I'm in the 37% today, 37% income tax bracket, and I'm saving $10,000 into a traditional 401k plan, I get a $3,700 benefit. But if I'm in the 15% income tax bracket and I'm saving $10,000 into my traditional 401k plan, now my benefit is only $1,500, right? So considerable difference when it's the same amount saved. So Joe Biden's proposal really targets this by saying, rather than getting a tax deduction, income tax deduction for your savings into the traditional side of a 401k plan, let's give everyone a 26% income tax credit. So really a flat tax credit across the board. One important thing to remember is a tax credit is not the same as a tax deduction. If you take a look at, well, just think about like $100,000 invested in the markets. If you get a 50% loss on $100,000, you've now brought your balance down to $50,000. If you get a 50% growth rate on your $50,000, that doesn't bring you right back up to $100,000. The difference between a deduction and a credit kind of works the same way. A 26% income tax credit could be equated to a 20.5%, a deduction at the 20.5% income tax rate. So if your income tax rate is higher than 20.5%, you're not going to love the fact that you get a 26% credit. Think of it like this: $100 at the 20. If you contribute $100 to your traditional 401k plan at the 20.5% tax rate, you're really taking $79.50 post-tax and saving that into your plan and getting $100 ultimately saved because of the tax benefit. Now the inverse is true. Again, that 26% tax credit. If you're saving $100 into your traditional 401k plan at a 26% tax credit, you're really saving $79.50, and the government is then contributing that difference on top of that to get you up to $100. And I think that's an important point. The question of, where does this tax credit come into play? I've read a number of places that the expectation is that the government will be contributing to your plan that 26%. So almost like a matching contribution like your employer gives into the plan, like your employer will contribute to the plan if you have a match on your 401k plan. Now, to understand the planning opportunity that this represents, you have to understand the difference between a traditional 401k plan and a Roth 401k plan. Traditional 401k plan, again, everything that's saved into it represents pre-tax savings. You get a tax deduction for that savings, so it comes off of your income. The money then grows tax deferred in the traditional 401k plan, meaning you don't pay taxes on the growth as it grows. But then in retirement, when you take money out of your traditional 401k plan, you're going to pay income taxes on everything that comes out as it comes out at your ordinary income tax rate at that time. Right? So the Roth, in contrast, the Roth gives you the opportunity to save post-tax dollars into your 401k plan. Because remember, you can have a traditional 401k and a Roth 401k in the same plan. Post-tax dollars saved into the Roth will then grow tax-free, not tax-deferred, tax-free. And we say it like that because according to current tax law, and I think that's an important thing to note, according to current tax law, which can change, according to current tax law, the growth inside the Roth will never be taxed to you. When you take that money out in retirement, if you take it out in the right way, totally tax-free income. So for those folks, when we talk about planning opportunities, for those folks that are maybe in the higher income tax brackets that are thinking, look, my income tax bracket is well above, 20.5%, like we talked about, the equivalent that you'd have to get for the deduction to equate to the 26% credit. If my income tax rate is above that 20.5%, I'm losing some of that benefit, and it's a considerable loss. Why not choose to pay my income taxes on at my income tax rate at the time and get totally tax-free income, totally tax-free growth while my money is in my Roth? Right, so a huge planning opportunity. We expect in our industry that more and more folks are going to focus, assuming the laws don't change on Roth 401k plans, are going to focus their efforts in saving into the Roth 401k. Also, don't forget the Secure Act, which was passed not too long ago, which feels like a million years ago with how quickly news moves these days. The Secure Act changed the benefits to beneficiaries should you pass away, should someone pass away with a traditional 401k or traditional IRA. The new law requires that beneficiaries, so younger beneficiaries, non-spousal beneficiaries, take the entirety of the distributions from a traditional IRA, beneficiary IRA, or traditional 401k out of the plan in a 10-year time span. That's a considerable tax burden for those maybe children of someone who had saved a considerable amount into a 401k plan, traditional 401k plan. The Roth, while it has these same requirements, you have to take that money out according to the Secure Act. You have to take that money out within a 10-year time span at no income tax expectation. Given the fact that they will be totally income tax-free distributions, taking the money out in 10 years isn't going to create the same kind of tax burden. Again, one more reason why I think folks are going to be focusing in that Roth space. One other component that I think is going to be especially impactful to our clients and to folks that are frankly investing is the idea that capital gains rate and qualified dividend rates are going to change considerably, or at least the proposal suggests that they would change considerably. The current maximum tax rate on capital gain, long-term capital gains and qualified dividends is 20% right now. Now you have to add to that the net investment income tax, which was put into place in 2013, 3.8%. So at most, today, someone could be paying 23.8% taxation on capital gains, long-term capital gains, and qualified dividends. That net investment income tax comes into play when you're a joint and married. When you're filing jointly. You got to help me out here, Steve. When you're married and filing jointly at $250,000 in income. At $200,000 income, individual, correct me if I'm wrong here, that's when it kicks in as well. So again, 3.8% for a lot of folks is currently the way it is. The proposal assumes you're earning over $1 million to suffer a greater impact, right, of taxation on long-term capital gains and qualified dividends. If your income is over $1 million, the ordinary income tax rate would apply. And if some of these proposals that he's put forth come to fruition, your ordinary income tax rate at that level will jump from 37% to 39.6%. Now you're talking about going from a 23.8% tax rate at that level to roughly a 43, almost 44% tax rate on long-term capital gains. Long-term capital gains and qualified dividends. Well, long-term capital gains apply to not just, hey, I sold this stock and made a bunch of money on it, but maybe you're selling a business. Maybe you plan on selling a business next year. That's a considerable tax burden to bear. If you already have a buyer on the hook, you might want to talk to your CPA about the prospect of what does it look like to be able to try to close this deal by the end of 2020. Because the expectation, and again, correct me if I'm wrong here, Steve, the expectation is any tax law changes that might occur next year could likely be backdated to January 1, 2021.
Yeah, we could be looking at 2021 or 2022. I guess the caveat is we don't know what's going to happen with the Senate. And if the Republicans would get one Senate seat in Georgia, potentially maybe none of the tax laws do change. But we have to put it out there to just so people are aware of it, that these taxes are what's proposed, and that's what President-elect Biden would like to have happen.
Yeah, I think as Tony points out, if you actually have someone who is considering retiring and selling their business, or you already have started the process of possibly selling your business, you really have to take a hard look and say, do I need to get that done by the end of this year? Because I'm going to do it anyway, or is it something that's a little bit further down the road, and then you'll have to wait and see whether or not the tax rates are going to be retroactive.
And when we talk about something like that, in my mind, the big planning opportunities for those business owners are going to be shifting your income and shifting your deductions, right? Because if you expect that your ordinary income tax rate or tax rates are going to be higher next year than this year, you still have some time, ostensibly, to make some changes to what your tax situation looks like this year. Taking income, if you have the option to choose whether you take it next year or this year, again, you talk to your CPA, you talk to your attorney and find out whether or not this makes sense. But taking income in a year when you know your tax rate could be lower and pushing deductions to a year when you think your tax rate could be higher makes those deductions more meaningful, makes the income less expensive. And when we talk about capital gains, same thing is true. We just call it shifting gains to this year and shifting losses to next year. Again, more opportunities for planning, but we've got a very tight timeline for getting these things done if it suits your situation. From the investment side, I'm having a lot of conversations with my clients these days about the prospect of Roth conversions. Roth conversions normally work best, in my opinion, when the markets are lower, because if you think about the number of shares that you're converting from a traditional IRA to a Roth IRA, if that number of shares remains the same as it would when you're transitioning from a traditional to a Roth, you want the value of those shares to be worth less, so your tax consequence on the conversion from the traditional IRA to the Roth IRA is far less, right? And then you want the money to grow again when it's growing in a tax-free way. So earlier in March, April of this year, when the markets really took quite a steep decline, that was, in my mind, one of the greatest opportunities this year to take advantage of Roth conversions for a lot of my clients. Should something like that happen again before the end of this year, paying your income taxes at ostensibly lower income tax rates, converting a smaller amount from a traditional IRA to a Roth and letting it grow tax-free makes a lot of sense to clients, makes a lot of sense to folks, I think. So every one of these planning opportunities needs to be taken into consideration, of course, with not only what your tax situation looks like, but what does your estate plan look like? How will your estate plan be impacted by this? And Mike is going to be able to talk us through that.
All right, so thanks very much, Tony. As we go into the estate tax changes, many of these are going to have to be coordinated with income tax changes, with your changes in your portfolio, based on what you think the economy is going to do, what the tax code is going to do. And some of the estate tax change proposals are pretty significant in not only the dollar amounts, but in basically changing the way we look at the world. We have the first proposal that they talk about is the elimination of step-up in basis at a person's death. This has been a cornerstone of the estate tax code going back to its origins back in 1917. We tried once in 1976 to have what they call carryover basis. The idea there is, under the current code, if you own an asset, whether you inherited it or you built it, and it had a very low basis, say it's worth $100,000, at the time of your death it's worth $1 million, for tax purposes you were able to step up the basis for up to the $1 million when you die. Because of the current exemptions that we have, there would be no estate tax on that. And if you sold it the day after you died, there'd be no income tax because there'd be no capital gain. The idea of carryover basis is, when you die, you don't get that step up in basis, so the asset is still $100,000 and your heirs inherit the $100,000 basis. If they sell it the day after you die, they have a $900,000 capital gain. And not only are they paying a capital gain, but if we get the increase in the capital gain rates that they're talking about, this has a significant impact on how people, when they should sell their business, how they should sell their business, or how they should transfer their business. The good news is, if anybody bothers to take a look back at 1976 to 1978, when we had carryover basis, it was an absolute nightmare, and nobody really understood it, including the people that proposed it. So the hope is that as they go through the consideration of the different changes, somebody will take a look back at that and say, this really wasn't a good idea. Tony, Steve, I don't know about you, but can you imagine your clients trying to keep track of basis for several generations, not only just for themselves?
Well, I mean, the thing I think about is just like, I mean, when we talk about losing that step up in cost basis, being in central Pennsylvania, knowing a lot of, families that own farms and have owned farms for many generations, the next generation doesn't necessarily have the liquid assets to be able to cover the cost, the tax cost or the tax burden of, a parent or a family member passing away and leaving them, that property. Will we get back to a place where they have to sell that property in order to pay the taxes? And that's frightening, certainly for some of my clients.
Yeah, absolutely. And I know we have at least one case in our office. It's the fourth generation from the farm. It was bought in 1918.
Wow. For
$200. The current value is $2.3 million. And it has been gifted each successive generation. It has not gone through an estate. So in the event the family sold that, they would essentially have almost 100% capital gain. And that is not unusual in the central Pennsylvania market at all.
But they would still have an opportunity to gift it, given what the exemptions are.
Right, they could gift it, but if we get the step up in basis loss, if the next generation has to sell it or wants to sell it, they're kind of strapped now they're going to lose a significant portion of that if they go through the loss of step up in basis. So that's one of the more significant proposals. We're hopeful that doesn't happen. But it's certainly something that you have to consider as you're going through a succession planning or an estate plan for any of your clients that either have farms that were gifted or business interests that were gifted in particular. The other changes that we look at as we go through the estate taxes are a decrease in the estate tax exemption. So currently we have an $11.5 million exemption for an individual, $22 million, $23 million for a married couple. It's important to note that is expected to sunset in 2025. So even if Congress does nothing over the next 5 years, in 2025, that's going to decrease by half. It'll be $5.5 million per person, $11 million per couple. So we've already started talking to clients about whether or not they want to take advantage of that exemption now. But with the proposal on the table, some have saying it's going to revert to $5 million. Some have said $3.5 million. We've even heard $1 million in some situations. That will have a major impact on anybody that is looking at transferring a family farm or other real estate, a family business. If your succession plan entails gifting it to the next generation or transferring it to the next generation, you certainly want to consider, do I need to do that this year while I have $11.5 million or a $22 million exemption for a couple, or do I wait and see what happens? But if you're looking at, if it's again, one of those plans where you think I'm going to do it, it's just a matter of when, this type of proposal certainly makes you take a look at maybe this year is the year. And because of COVID and because of the recession, many businesses now are at a lower valuation. Because of the decrease in economic activity, it might be a perfect time to combine the high exemption and the low valuation to make a gift or to make some other transfer, as we'll talk about later, to the next generation in order to take advantage of the interplay of those two situations.
And from a planning perspective, I would think that this also opens up the doors to more folks considering life insurance in life insurance trusts to try to offset some of the cost of the estate tax impact.
Absolutely. ILET's kind of in irrevocable insurance trust, or ILETs, we're great with acronyms in estate planning. You'll hear some of them later. But they kind of lost favor because of the increase in the exemption over the last few years. They were often used to set up because you had tax-free money from the insurance that was then used to pay estate taxes or inheritance taxes, or if there were some liquidity issues in the family. They kind of went out of favor for a few years because the exemption amounts were so high that very few families were actually experiencing taxes. But now with the changes that are being proposed, ILETs are definitely something to consider, whether it's to transfer a business. It may give you a way to transfer more wealth if the business is going to have high capital gains, if you're not going to be able to use the full amount of the exemption, or if we expect that the tax rates as they're proposed are going to go up and the exemptions are going to go down. An ILET is definitely a vehicle that you want to consider in the short term to take advantage of the situation.
Mike, how about the portability? Like someone who had a spouse pass away during that time period when the exemption was so high. What happens with that portability of the exemption, or does that go away?
Okay, the portability, the concept there is you each have an exemption, a husband and a wife has an exemption. Under the old rules, it was a use it or lose it situation. If I had a $5 million exemption, I didn't use it, I passed away before my wife, she did not get the advantage of my exemption. The last Tax Act, they introduced the concept of portability. If I had that $5 million exemption, I didn't use it, my wife could then file a tax return, claim my $5 million exemption, and now she had a $10 million exemption. The proposal is to get rid of portability again, go back to a use it or lose it situation. And Steve's question is, well, what happened if you died and you exercised the portability? Will that carry over? And as far as we've heard so far, they are planning on honoring those. So if you had a carryover of portability, you should still be able to use that going forward. But that would end most likely December 31st because they're talking about any changes in 2021 being retroactive to January 1. Don't really see much of a planning opportunity there. I can't imagine, at least I don't think I have any clients that are going to volunteer to die early in order to exercise a portability exemption. But it's certainly something to keep in the back of the mind that if you have already exercised it, you should be able to count on continuing to exercise that. But again, if you're thinking of gifting, any kind of gifting strategy or transferring into a trust strategy or an ILET to make up for the fact that you might lose the portability, that is something between now and the end of the year that you would want to consider.
So if you've got like a $20 million estate and you're looking down the road and you're thinking, hey, you know, I might want to take advantage of what's available to me today, you could ostensibly gift, you know, a fair amount of that.
Absolutely.
And that doesn't, you know, as the coming years, we see if we end up seeing the exemption reduced, they haven't lost that. They've already taken advantage.
Right. They've taken advantage of it. And that's one of the reasons that we're putting on this program is if you're in that type of a situation, or you may be in that type of a situation, you certainly want to take a look at what steps can I take now to take advantage of the playing field as it is. So in addition to the exemption amount, they're talking about decreasing the gift tax exemption. That was, at first, it was not in sync with the federal estate tax exemption. The estate tax exemption went up, the gift tax kind of dragged behind for a while at $1 million or $2 million. Now they're talking about decoupling them again. So if they go on the estate tax exemption, it may go from 11.5 to 5 million, possibly down to 3.5. The proposal for the gift tax is to go back to the million. So in the situation that we talked about, if you're in that higher bracket now and you want to transfer that business, that piece of real estate, because you think that the exemption is going to come down, it's okay to do that now because the gift tax and the federal estate tax exemption line up. However, if you wait to make that gift in the future, even though the federal estate tax exemption might be higher, the gift tax, you may now be restricted to $1 million exemption, and they're not going to be in sync, and it makes you take a harder look at what the gifts are going to look like going forward. Generation skipping tax, we talk about, that's another kick in the estate tax area. The idea is if you leave something directly to your children, you're entitled to the exemption. They have, in the past, there's been a difference between leaving it to your children and leaving it to your grandchildren. If you skip a generation, you make a direct skip. The generation skipping tax is a whole different tax system that runs parallel to the estate tax. So it's a layer of complexity. In the past, also, the exemptions didn't match up. So you might have had a $5 million exemption for federal estate tax, but the generation skipping tax might have only been $2 million. We're not sure what the proposals are going to be for that going forward. Right now, they are in sync. So if you wanted to make those types of gifts and you had a plan in place, multi-generational plan now, where you were making gifts to your children, but now you felt that they were in a good enough position that you could skip them and make gifts directly to the grandchildren or make a bequest to the grandchildren, now we got to take a step back and say, well, is it still going to look the same going forward? The idea here is to accelerate the estate tax as much as possible through these various proposals. And the idea may be that the generation skipping tax may not be as easy to plan for under some of these proposals as it is now. So there's not a lot of clarity there, but it's also a factor to consider. We know what the rules are now. And if this is something that you're considering doing, you may want to consider doing that now as opposed to waiting to see what happens in the future. The rates on the federal estate tax, again, they're talking about going up just like they are with the other income tax rates. So you're kind of getting a double kick. You're not only losing the exemption, but the amount of tax on what is going to be taxable is going to be increased. So from a timing point of view, again, are you looking at gifting? Are you looking at possibly waiting until the person dies in order to include it in the estate? Not knowing the step up in basis rules, there's a lot of uncertainty now. And a lot of the planning may depend on timing. Is it the right time for me no matter what happens? Do I want to get out of a business now because I don't want to see what happens? We had, after the recession, Steve, you might have seen this, we had a lot of clients they sold their businesses because they were just tired. Mm-hmm. I can't do this again. I'm not going to take the time to rebuild it. I'm at that stage in my life where it doesn't make sense. So they sold. We're now in the middle of another recession. We have uncertainty with the tax code, but it doesn't look like it's going to be anything good happening in the near future. It may be the time to take a step and take a look and say, is now the time to sell for those various reasons? Mm-hmm. Any of these types of decisions really require the whole team to be involved. What are the income tax implications? What are the estate tax implications? Gift tax? What effect does this have on my portfolio? What's going to be left for my financial advisor to invest to take care of me after I sell my business? All of that really has to be coordinated. And if you're going to do something between now and the end of the year, it's certainly something that you want to do sooner rather than later to give everybody the chance to get together, which, because of COVID, has become increasingly complex. What does getting together mean? Is it a meeting? Is it do we have a Zoom conference?
It's always Zoom anymore. Isn't it?
Yeah. In addition to business fatigue, we have Zoom fatigue. So you never know where these are going to go. But you certainly have to allow more time to make these decisions and to get involved in the planning of these decisions if it's going to be a year-end type transaction. We're going to proceed now to a live Q&A portion of this program. Any questions that you might have, please go down to the chat section or the comment section of the platform that you're listening to this on, and then your question will be forwarded to the appropriate member of the panel, and he'll be able to answer that question live for you. Okay, we do have a number of great questions in the queue here. Want to preface this session with a statement. Some of them talk about planning sessions or planning meetings between now and the end of the year, and all three of us would certainly encourage that. And I think, as you heard from all three of us, most of these questions really require a team meeting. So your financial advisor, your accountant, your attorney, and I know all of us will have a number of meetings between now and the end of the year, no matter what those meetings mean, whether that's in-person meetings or that's going to be Zoom meetings or whatever we're permitted to do. So if you do have some questions that require a meeting with the team, I would certainly encourage you to schedule those early, because we really don't know what the next 6 or 7 weeks are going to look like before the end of the year. So the first question in the queue as we get into this, Tony, is for you, and it talks about the tax consequences of a Roth conversion.
Sure. So it's a good question, and especially now, given everything we talked about in the presentation, the tax consequence of transitioning assets from, or converting assets from, a traditional IRA to a Roth IRA is income tax consequence. So whatever your income tax or ordinary income tax rate is, that's the rate at which you will be paying taxes on distributions from your traditional IRA, which ultimately are conversions, if you set it up that way, are conversions to a Roth IRA. The reason it's so important to understand the consequence of doing a conversion of a portion or all of an IRA to a Roth is that in times like this, when we look forward into the coming years and we fully expect that there will be changes to some of our respective income tax rates, well, now you have the opportunity, like we talked about in the video. Now you have the opportunity to look at your tax rate today and decide whether or not you want to pay income taxes on any conversions you make today versus income taxes on any conversions you might make in 2021 or 2022. Of course, when your ordinary income tax rate is lower, that's when it might make more sense for you personally to consider converting from a traditional IRA to a Roth. Any conversion, and I can't emphasize this enough, I've seen mistakes happen, any conversion you decide to make must, I would encourage you to consider having a conversation with your financial planner, having a conversation with your CPA before you step into it. Once you make the conversion, the tax consequences are yours. So certainly it's a decision that needs to be well considered. And I think to Mike's point earlier about one of these other questions, we always encourage you to take a meeting by the end of the year with your financial planner, with your estate planner, so with your attorney, and with your CPA. We believe, and I think the three of us believe, that the quality of your plan, of your estate plan, financial plan, tax plan, is only as strong as that synergy that you have amongst the professionals in your lives. If I, as a financial planner, am doing something for our clients, certainly the CPA needs to know what those things are and why we're doing it. And certainly the estate planning attorney will benefit from those conversations as well. You do well to read in all of these professionals in your lives to what it is you're doing.
Okay. All right. There's another one, another tax question here. Steve, this might be a little bit up your alley. Long-term stock benefits and withholding of taxes.
Am I coming up? All right, great. Steve Lubart here. So long-term stock benefits, if those stocks, if that stock is being issued to you and it's coming through as compensation, then you should consider withholding tax for that. If you are exercising those stock and actually selling that stock off,
you want to meet with your accountant and determine what your capital gains are going to be with that, and consider either making estimated payments or potentially having extra tax withheld from your W-2 or your actual paychecks that you have each pay. But you definitely want to consider having taxes withheld from that to make sure that you don't have a surprise for taxes at tax time. So I would sit down with your accountant, CPA, and see what the tax ramifications are there. I would definitely consider having taxes withheld.
Okay. And then we have another tax question here. This is a gift tax. Many of the strategies that we talked about might involve some form of gifting, whether it's an outright gift or whether it's a gift through a trust. And one of the questions was, if I do make a gift during the year, what are the income tax consequences of that? And there are no income tax consequences other than the basis issue that we discussed earlier. So if you make a gift, you might have to file a gift tax return depending on the size of that gift. But that's essentially telling the IRS, if you make a $100,000 gift, you're using $100,000 of your $11 million exemption. So there's no tax due. You're just creating a record that you actually made the gift and the amount of the exemption that you used. You'll get carryover basis because it's a gift. You're not waiting until it's not a bequest. So the donee, if you will, or whoever you made the gift to, should keep track of what your basis is in that asset, so that they'll have a tax record if in the event that they eventually sell that asset. Again, on the income tax side, there's no immediate tax consequences. You don't pay income taxes as a result of either giving a gift or receiving a gift. Steve, any other insight on that?
Yeah, I know we just touched on that. You want to make sure that that gift tax return is filed by April 15th due date, and there can be an extension filed, but you'll want to make sure you file gift tax return. And as Mike said, there's no tax due with the gift tax return. It's just a reporting for the use up of the exemption, the estate exemption.
Looks like we have a tax-busy crowd here.
Everyone loves taxes.
Yeah, there's a follow-up question. What will the capital gains on stock sales be?
Now, do you want me to handle that? I'll just step in and say, capital gains on stock sales today are either in the 0%, 15%, or the 20% bracket if you're talking about long-term capital gains. A long-term capital gain would mean, hey, I bought this stock or this thing today, and then a year later and a day, I sell this stock or thing. In that sale, again, the 0, 15, or 20% tax rate applies based on what your income is. So most of our clients are in the 20% long-term capital gains rate today. Short-term capital gains would mean, hey, I bought this stock or thing today, and then within that year period, I've then resold this thing. So I've bought it, then sold it in a year's time. Within a year, now I'm going to pay taxes on the gains, on the growth, at my ordinary income tax rate, right? Which could be higher than that 20%. Could also be lower than 20%. When the question really says, what will the capital gains on stock sales be? That's anybody's guess, right? We know that one of the proposals that's put forth would impact the capital gains rates for the long-term capital gains rates for those who are earning over $1 million a year. Now, if you fall into that bracket, you could jump from a 20% long-term capital gains rate to possibly a 39% capital gains rate. Currently, the highest income tax bracket is 37%. If it does jump from 37% to 39.6, which could be a possibility, if that occurs, then obviously you would, in $1 million, with $1 million in annual income, you would pay long-term capital gains at the 39.6 rate if this proposal comes to fruition. There are additional taxes on top of this. There's an investment income tax, and it can get even higher than 39. The bottom line is it could get even higher than 39.6% for some of those folks in the really high income ranges. And Steve, what would you have to add to that, if anything, being the CPA?
I know we said about the 3.8, as far as taxes, just it could be the 3.8%. And then you also have to consider that if you're in Pennsylvania, it's the 3 or 3.07% there. And I forget the exact rates we were looking at when we were looking at California, but it could be what, another 12% or something. Hopefully we're just dealing with people that are in PA here.
Yeah.
But I think you want to consider that the highest is going to be the 39 plus the 39.6 plus the 3.8 plus the 3%. So I think you covered it, Tony, as far as how what the capital gains would be and how it'd be handled.
Okay, and we had one follow-up question also on the exemption amounts. When the proposal that we had seen was talking about reducing the $11.5 million exemption to $5 million. That has since been clarified. Some of the proposals coming out of the Biden camp are actually saying that the exemption amount will be reduced back to $3.5 million. So we could go from a couple currently having a $22 million exemption. If nothing happens in the next couple of years, that will reduce automatically to $5.5 million per person or $11 million per couple in 2025, because there's a sunset provision in the current tax code. But if the proposal are accepted, we now get down to $3.5 or $7 million a couple. So that's a huge difference in the amount of exemption that'll be available over the next couple of years, even if nothing happens with these proposals. But if they are accepted, it's going to significantly change the landscape for making gifts in the next couple of years. Okay. I'm not seeing any other questions in the queue. So that being said, we would all be available to make follow-up answers to any of these questions. So you could respond to the Facebook page or send an email to one of us if you have a follow-up question, or if you wanted to meet regarding any of these issues. And once again, we'd like to thank you all for tuning in to this. And hopefully we provided you with some insight as to some possibilities that you could plan for between now and the end of the year.